Thank you for giving us the opportunity to express our opinion on the equity OTF. I will not be speaking about the other asset class OTFs because that's not my expertise. My name is Ryan Chidley. I'm a senior trader at APG. So the roadmap of this presentation is, first I'll give a background real quick about APG and myself. Then I'll be talking about how we as equity traders see the OTC market and equities fitting, or I should say, doing the same thing that the BCN does, or maybe another way of wording that is the way the BCN does the same thing as the OTC market, and how one is potentially evolving into the other. We can talk about that. Finally, I'll talk about how we hope some of the activities of the BCN will find a life in the OTF. Not all, but some. Okay, so here's the background. APG is a nonprofit pension administrator. We are an asset manager. Our only clients are pension funds. Our largest client is the Dutch public sector pension fund, whom we are completely entirely owned by. We have 300 billion euros in assets, which makes us in the top 50 in the world of global asset managers, and we are headquartered in Amsterdam, the Netherlands. You already know my name. I'm a senior equity trader on the equity desk. I sit with the other traders, so the other asset class traders. I've been trading completely on the buy side, so entirely for asset managers since 1997. I've never worked at a brokerage firm, so I don't have too much expertise in terms of how their internal mechanics work, but a little bit. European equity just since 2003. So I've seen the European equity market evolve a little bit. Let's see. So just so we all have some common language in terms of how I see where people sit in the execution industry. I'm in red. I'm a buy-side trader. That just means a trader that works for an asset manager. I report to a portfolio manager, and he has analysts that support him or her. Typically in an asset manager, you have these three types of persons in the investment staff. The analysts typically come up with a whole host of things to buy or sell. The portfolio manager makes the decision. And then my whole job is basically to go implement that decision. So it's important to realize that I don't actually choose what I buy and sell. And the same thing is true of my fixed income and foreign exchange colleagues. I just do what I'm told. And my entire job is to try to minimize the cost of doing that trade. And basically what that comes down to is my job is to minimize other people figuring out what it is that I'm trying to do before I can do it. So that's the way this industry has always been. And the people that I talk to on a day-to-day basis are your sell-side sales traders, who we typically call brokers. They've got a trader that sits next to them. And then we used to have floor traders and market makers. And when I started this business in the 1990s, when you talked about people that we didn't want to know what it is we were trying to do before we could do it, you would be talking about the sell-side trader, you'd be talking about the floor trader, you'd be talking about the market maker. Nowadays you're talking about hedge funds and HFT primarily, but it's basically the same game. So this is how the industry has evolved, in my opinion, over the last 20 years, and this is where I think it's going. The M's are manual. A stands for automation. So basically, I got into this business back in mid-90s, and at that time, all of these different roles were actually quite manual. That is to say that the roles and the added value that they provided in the industry, or disvalue, depending on what your opinion is, were not automated. They were not being replicated by software. But beginning in about 2000 and up until now, you see more and more of the roles in the industry being replaced by software, particularly intelligent software, artificial intelligence. And that began down at the bottom of the food chain with the market makers and the floor traders. And it's been slowly working its way up. And when we talk about the BCN or OTFs, we're talking about that little red letter A, which is, in my opinion, the automation of the broker or sales trader's role in the execution process. And as you can see by 2020, I'm just guessing, but I can see my job also being automated by the wonders of software and artificial intelligence. Okay, so now I'm going to talk about the OTC market, how we use the OTC market. When I heard the other speakers, I want to make a distinction between OTC market for equities and that for non-equities, Because unfortunately in finance we've got these words that mean very different things in different contexts, and it's very confusing. One thing I want to point out here is that OTC equities and OTC bonds, whenever you do a trade, what happens is that the trade settles in 3 days and you don't have any counterparty risk after that. So that's very different from credit derivatives and swaps and other OTC derivatives, because that was actually one of the things that sunk us in 2008, 2009. It was the ongoing counterparty exposure that continues after the date of trade. So anyway, we use the same word, but it's a very different thing. And I'll talk about in a second what we mean by OTC and equities. This is basically how I, as a buy-side trader, think of the orders I get from my PM. I think other buy-side traders think of our orders in the same way. Every order we get, we bucket into one of these 4 boxes. We ask ourselves how urgent is the order, and we ask ourselves how illiquid is the order. And depending on where you fall in this matrix is going to be a very different strategy in terms of how you execute the order. And it's always been this way, and I expect it will always be that way. So basically you can see the easiest orders for us are ones where there's no urgency and it's a small order relative to liquidity in the market. Those are increasingly automated orders. The orders which are not urgent but are very high in terms of ADV, that is the size of the order vis-a-vis the market liquidity, these are where most of our orders are for us as a pension investor. And you've got some orders which are very urgent but are small in size, and these would characterize our quantitative internal clients. And unfortunately you get some orders which are highly urgent, that is that there's news out in the name or the market's going lower and you're a seller and it's a very large order. And so basically by the time you get done with this order, it's going to be 1.5% worse than when you started with the order. And that's your fill price, which means that actually the stock price has gone down 3% since when you got the order. So again, our whole job as buy-side traders is just to minimize those numbers there. This is how we look at the different venues in terms of ways in which we can execute our orders. It's always been this way. I expect it will be this way going forward. Basically, there are some venues where on the safe side you've got a low probability of fill, that is of getting your order done, but there's a high potential for liquidity and there's a minimal risk of someone figuring out what it is you're trying to do. So, for me, I would put, say, the Norwegian pension fund in this bracket. I would put, JP Morgan Asset Manager up in that bracket. I would put State Street. Other large asset managers are simply trying to shift large blocks of an equity. Then you get down into careful, which are, let's say, large asset managers but have internal hedge fund strategies or who have quantitative strategies. And then finally you get to dodgy. And you can see dodgy, you have a higher probability of fill, but there's a greater risk that someone figures out what it is you're doing, and you're not going to get as much liquidity. So we have this perspective not only on counterparties, but also on venues, such as particular exchanges, MTFs, BCNs. We have this perspective on sales traders, on brokers. This is just how we generally look at the execution. So as an example, this is not too different for how we currently look at some of the different venues in the market. This is at the brokerage level of analysis, so I didn't talk about, it's brokers and destinations. The distinction's blurring these days. So on the far left would be a liquid net and some BCNs. So you can see right here that for us, some of our best places to trade are some of the BCNs, not all. Then you have indications to sales traders. That's the OTC market for equities, indicating to Cantor's Fitzgerald that they're a broker. Broker IOI, again, that's the OTC equity market. So that's where a broker advertises to us. That's letter E, whereas letter C would be us advertising to a broker. F is other dark pools, and G are the exchanges. And the reason why we believe the exchanges right now are amongst the least preferred places to trade is because of the presence of HFT and the small order size. So let's assume we called a sales trader, because we're talking about the OTC equity market here, and we indicated to them that we were a buyer of a proper block of stock or a seller, and they need to now go find the other side. So now we're getting into the mechanics of how the OTC equity market works. They are going to look at their clients in the exact same way that we look at our counterparties. They're going to have the same image in mind. If I've told them, based on my strategy, that I am urgent and that I need to get this thing done quick, then what's going to happen is they're going to proceed very quickly from safe, careful to dodgy. Whereas if I've told them that there's no urgency to this order, I can get it done today, I can get it done in a week, then basically I'm looking for that sales trader to spend a day or two in the safe category and not do anything else. And that's what we mean by discretion, and I'm going to get to that in a minute. But basically, what discretion means is it means the broker behaving in a different way based on how they read my needs at that particular moment in time.